Hello, I'm Russ Mould, AJ Bell's Investment Director, and in the next few minutes we're going to give a very brief presentation on the concept of risk and return. We all think of investments in terms of return and the gains that we can accrue or the income we can manage and generate, but we also do need to focus as investors upon risk because things can and do go wrong, and as the old saying goes, share or security prices can go down as well as up. And this is a presentation to look at how you can measure the potential upside and downside and see whether a security is worth buying if you think the upside offer more than compensates for the downside challenge. So we're going to go through a few very, very brief sections here. But before we go any further, there is here a disclaimer. Please do read this at your leisure. It is extremely important indeed. And then here are the contents. So we're going to very quickly go through these topics. The 4 questions that first of all you need to ask yourself before you go upon any investment journey or make any investment decision. Then we will look at how to define risk. Then we'll look how to manage it. And then we'll come to a few conclusions which hopefully you'll find helpful as you look to build your portfolios and get the best risk-adjusted returns that meet your particular personal circumstances, needs and requirements. So you can hopefully get the best possible outcomes. So these are the big 4 questions, and before you even think about building a portfolio, or even looking at a fund or a stock or a bond or a commodity, please think about these. It will save you a lot of heartache. First, why am I investing? Why am I putting my capital at risk? What is my long-term goal? Which you can largely be defined as, well, how much money have I got now? How much money would I like when I finished? And then you can work out the fun stuff, which is what you're going to spend it on. Secondly, that you will then decide over how long am I going to put my capital at risk and tuck it away. It may be for a few years to save up for a holiday or school fees. It may be something much longer like a pension, for example, where you're potentially saving for 40 or 50 years or longer. And that will then help answer the third question, which is what is my target return? Because if you know how much you want by the end and how much you have now, you know what your overall return you're looking for is, then you know how long you're looking to seek that for, then you know roughly what your annual return is on average. You'll never do it metronomically. Only Bernard Madoff managed to make out the exact money he wanted to generate every year. That's because he was cooking the books. But once you've done that, you can look at, again, how much do I want, what time, annual return, and then finally, how much risk am I prepared to take seeking my average target annual return? Okay. Now, once you've answered those questions, you'll get a very good feel for which asset classes are most suitable for your particular needs and requirements, what type of platform you require, what type of instruments you're looking to invest in, whether it's funds, active or passive, or whether it's individual securities or products, and then you'll be finally able to decide over time how to balance those in the proportions and weightings that again suit your particular needs, whether it's capital or income or a balance of the two. This then takes us to this issue of how do you define risk? Well, let's leave it to one of the most famous and successful investors of all time, and let's so can be dispassionate about it as possible, Mr. Warren Buffett, Chief Executive and founder of Berkshire Hathaway, an investment company with a fantastic long-term investment record. And he defines risk as using the dictionary sense as in personal injury or loss. So in a financial terms, what are we looking at? We're defining risk as the loss of your money. And so your ability to embrace risk is your ability and willingness to withstand loss in search of returns. Because let's face it, we do get the odd thing coming out of the clouds that happens unexpectedly, whether it's a pandemic or in a more extreme environment, a bear market or an economic downturn. So bad things can happen occasionally, and it's there about making sure you're prepared for those to protect your downside as well as harvest the returns which you're seeking. Now, there are multiple different types of investment risk, they're all the same. Now, the first one is the one that perhaps Mr. Buffett's talking about, too much risk, overreaching, going beyond your parameters and suffering a permanent loss of capital. And I stress permanent, because share prices, security prices will move up and down, but those losses only crystallize and become permanent when you sell. So in some ways you could argue perhaps that one of the secrets of investing, because there will be ebbs and flows in the market, and Mr. Buffett has said that he's seen his personal portfolio fall by 50% twice in his life through no fault of his own, just because there have been major bear markets. So designing a portfolio that can get you from there to there without you feeling the pressure of selling is going to be an extremely helpful mechanism if you can do it. There is a different risk, which is taking too little risk and missing out on potential returns. And perhaps the worst of all is taking the wrong risk. You maybe get a little bit overexcited, a little bit cocky, take a tip from a mate down the pub, and end up with the wrong type of risk that leads to poor risk-adjusted returns. So you may be taking an awful lot of risk, but for not an awful lot of return, a lot of volatility, and perhaps a lot of sleepless nights. And ultimately, investing is about sleeping soundly at night as you try and step towards those financial goals that you've set out for yourself and those outcomes that you desire. So how do we manage that risk? Well, this is, I don't know whether Seneca the Younger was an investor or not, but he was certainly a philosopher and his words were worth bearing in mind. I don't know what's going to happen, but I do know what's capable of happening, and none of that will give rise to protestation on my part. I'll be ready for anything. And then really what you're trying to do here is devise a portfolio that is going to protect you when things go wrong and certainly try and minimize your downside, but still give you upside potential when things go well. Now, we generally achieve this in portfolio terms through diversification, by not just assuming that your preferred, assumed, expected economic or stock market scenario develops, but a financial market or economic scenario develops, but a range of them. It's all very well thinking and doing very diligent research and thinking, I think there's a tremendous economic boom coming. There's going to be really strong corporate profits in these sectors, and going all in on those, there is a chance, no matter how smart you are and how diligent your research, that you're wrong because something unexpected happens. So it's being prepared not just for the one scenario you think is going to happen, but for a range of them. And different asset classes have different characteristics, and they can help you prepare for those different scenarios. So first, how do you then manage this risk and be prepared for many different things? The first one, again, is to go back to answer those 4 key questions. Why am I doing it? What's my time horizon? What's my target return? And what's my appetite for risk? That will shape, again, the type of asset class, the type of product provider you use, the type of instruments that you use. Know your circle of competence. Do not give in to fear of missing out. If you don't understand something, either research it really, really, really diligently, or just walk away, because buying something you don't understand will make it much harder for you to manage it and understand the risks and the downside, as well as the potential and the upside. Again, prepare for the range of eventualities, not just one. Then have your plan, backtest it. See if it works first before you put your cold, hard cash at risk. And also, we know that in the end, although we can use the past as a guide, and history does tend to rhyme, it never exactly repeats itself, and the past is no guarantee for the future. And if it were, as Mr. Buffett put it, then the librarians would be the richest and best investors. And this is a slightly more facetious way of thinking about it. It's tough making predictions, especially about the future. So thank you very much, New York Yankees player Yogi Berra. So I've mentioned diversification, and on a very, very top-down basis, there are lots and lots of different asset classes that you can think about and invest in. So it doesn't just have to be shares or just cash or just bonds. You can have a range of them, and building a portfolio will help you prepare for a range of eventualities and try and keep some income or some capital gains trickling in, depending upon what your strategy is, whatever happens. And as you can see, though, all of these asset classes have different characteristics, from a potentially modest return, but with a fair degree of capital protection and safety, to potentially high returns, but with greater downside risk and certainly greater volatility, and also the potential, how easy it is to buy or sell them when you want to sell them. Now, when we talk about liquidity, we generally refer to how easy it is to trade something when you want to get in, when you get out. But it's not quite that simple. Real liquidity is being able to buy what you want, when you want it, in the size of position that you wish, at the price that you desire, i.e. the price on the screen. Now, it's all very well just clicking on a mouse and waggling and thinking that's really, really easy. But whenever you place, say, a sell order, so there still has to be a buyer out there. If you place a buy order, there has to be somebody who's selling out there, and that person has to be found. Now, during the great stock market crisis of 2007 to 2009, there were FTSE 100 stocks that were very, very difficult to trade. The bid-offer spread was up to 10% because there were people just running for cover and nobody wanted to buy. During the great crash of 1929, there were no bids on offer for many stocks, no matter how good they were. So do not take liquidity for granted. Never assume that you can just click a mouse and get the price you want, in the size you want, in the security you want, at the time you want, because it's not always possible. So again, building a balanced portfolio so you don't add pressure into selling when you don't want to at the least opportune time, is one way of avoiding that particular mental anguish and potential financial hit. So all of these different asset classes can do a job for you. Some will provide income, some will provide potential capital gain, some have the opportunity to present you with both, but albeit in exchange for different degrees of volatility and different degrees of downside risk. And by volatility, that just means the security's price moves around, potentially a lot. Now, that isn't necessarily a bad thing, because it can be opportunity. Because if something dips for you think for no good reason, it's a chance to pick it up cheaply. If it spikes to a very, very great degree, more than perhaps you're expecting, you may view that as a chance to lock in some profit. Or you may just decide to ride the whole thing out, keep your dealing fees low by not doing too much, and just let your portfolio do its thing because you're happy with what it's doing. So just very quickly, I won't go through every individual option here, but cash naturally offers you a degree of safety in nominal terms. Inflation is your enemy there, but it does offer you positive returns, at least now that interest rates have gone back up again. It's easy to move around, so it's liquid, and it isn't volatile. At the other extreme, you've got cryptocurrencies. Prices move around an awful lot. They do potentially offer you capital returns. There's no income involved. They are in theory liquid, but boy, do they move up and down an awful lot. In the middle, you have things like share prices, equities, no degree of safety. Share prices can go down as well as up. Yes, they can offer you income and capital returns when things go well. Yes, they can be easy to trade, but generally the bigger caps easy to trade than the smaller caps. And yes, they can be awfully volatile. Bonds a little bit different again. And then you have things like funds, and that depends what the fund invests in. Real estate potentially offers you income from rent, potentially offer you capital gains if things go well. Is it easy to trade? No. So again, you've got to think about the different trade-offs there and the different opportunities and risks and returns that these particular asset classes can offer. But a range of them can, in theory, help you follow Seneca's route of being prepared for inflation, deflation, stagflation, growth, recession, targeting income, capital. And it's a matter of, again, doing your research against those 4 key questions to work out what you want, income or capital, so you can target the best outcomes that you're seeking, risk-adjusted, by balancing those asset classes and their characteristics against the desired outcomes and goals. So in conclusion, answer those 4 questions. Why am I doing it? What are my target returns? What's my time horizon? And how much risk am I prepared to take before you do anything? Have a plan, back-test it, stick to it. Beware of greed and fear, powerful human emotions. Greed could potentially suck you in at the top. Fear could tempt you to sell at the bottom when you're providing somebody else with a bargain. And if you can avoid those temptations, generally you'll sleep better, avoid compounding fees, which will erode your returns, and get some better risk-adjusted returns over the long term. And investing is all about the long term. Do think about risk as well as return. Do build in a margin of safety, and you do that by focusing on valuation. And think about rebalancing. If you've got a particular part of your portfolio that's done brilliantly, you might end up with more in bonds than you would normally have or feel comfortable with, or more in shares. And there's nothing to stop you once every year or 2 years, just rebalancing and going back to your original weightings so you're not getting too exposed to one particular asset class. Remember, liquidity is there, but as Dorothy Parker said about love, it's like mercury in the hand. Clutch it and it darts away. It's never there when you need it, so don't rely on it to get you out of trouble. Try and build that portfolio so you don't find yourself having to sell at the wrong time when things are going wrong, and you can sail through that volatility or even have some cash to take advantage of it if somebody else is a forced seller. Do plan for tax and be patient. Are you trying to time the market and time the movement of money, or are you using time in the market to help you generate long-term returns? That will be a matter of, again, your own personal plan, style, needs, and requirements. And just as a final conclusion, how to try and protect yourself and manage risk without getting just blindly chasing return. This is Sir John Templeton, founded the Templeton Fund Management business, died a billionaire, smart guy, good investor. People are always asking me whether the outlook's good. It's the wrong question. The right question to ask is, where's the outlook most miserable? And by that he means, that's where there are bargains to be had. And the lower the valuation of the price you pay for a security, the more downside protection you have, the more upside potential you may get. Thank you very much for your time. I greatly appreciate it. I hope that was helpful. And I look forward to seeing you again next time.